Something shifted this morning. And if you were watching the markets at 11 o'clock, you saw it happen in real time. Silver moved in a way that caused trading desks to pause, not because of speculation or social media hype, but because of something deeper, something that's been building beneath the surface of our financial system for years. This isn't about predicting where prices go tomorrow or next week. This is about understanding what's changing in the structure of global finance and why assets like silver are responding the way intelligent money expects them to during periods of monetary stress. If you hold silver right now, you need context. If you've been watching from the sidelines, you need clarity. And if you think this is just another price spike that will disappear by Friday, you need to understand why this time the underlying conditions are fundamentally different. My job today isn't to excite you or frighten you. It's to walk you through what's actually happening, why it matters, and how experienced investors think during moments like this. Because the difference between wealth preservation and costly mistakes often comes down to understanding cycles rather than reacting to headlines. Let's begin with what actually occurred, and then we'll build the complete picture together. At approximately 11 o'clock this morning, silver experienced a sharp vertical move that caught the attention of commodity traders worldwide. Within minutes, the price jumped in a way that suggested either significant institutional buying, a supply concern, or a technical break that triggered algorithmic systems. But here's what matters more than the move itself: the context in which it happened. This wasn't an isolated event in a vacuum. It occurred against a backdrop of deteriorating confidence in currency stability, mounting sovereign debt concerns, and a growing realization among institutional investors that the monetary experiments of the past 15 years are entering a new and uncertain phase. Silver didn't move because someone on social media decided to coordinate a buying campaign. It moved because the fundamental reasons for holding hard assets are becoming harder to ignore, even for conventional investors who've spent years dismissing them. The morning's action was sharp enough to trigger stop losses, activate breakout algorithms, and force short positions to reconsider their thesis. And when you see that kind of technical momentum combined with deteriorating macroeconomic fundamentals, you're witnessing something that deserves serious attention. But let me be clear about something important. A single morning's price action is never the full story. What matters is whether this represents a temporary spike or the beginning of a structural repricing based on changing monetary conditions. And to understand that, we need to step back and examine the forces that have been building for years. Let's talk about what's really driving this moment, starting with the most basic question. What has happened to money itself over the past 15 years? Since the financial crisis of 2008, central banks around the world have engaged in the largest monetary expansion in human history. They've created trillions in new currency units, purchased government bonds on an unprecedented scale, and maintained interest rates at historically suppressed levels for over a decade. This wasn't a secret, it was official policy, conducted in broad daylight, with the stated intention of stimulating economic growth and preventing deflation. But every monetary action creates consequences, and we're now living through the phase where those consequences are becoming visible in ways that affect ordinary people's purchasing power, savings, and financial security. Inflation isn't a mysterious force. It's the predictable result of expanding the money supply faster than the economy produces real goods and services. And while official statistics can be massaged and methodology can be adjusted, people living in the real economy know exactly what's happened to the cost of food, housing, energy, and healthcare. This matters for silver because precious metals have historically functioned as a store of value during periods of currency debasement, not because they're magical, but because their supply cannot be expanded at the whim of a central bank committee. When currency loses purchasing power, investors seek assets that maintain value. This is pattern recognition, not speculation. It's happened in every major inflationary period throughout recorded history. Now let's address the elephant in the room that most financial media refuses to discuss honestly: the mathematics of sovereign debt. The United States federal debt now exceeds $36 trillion. This isn't a political statement, it's arithmetic. And the interest payments on that debt are approaching levels that consume an ever larger portion of government revenue. When debt reaches certain levels relative to GDP, governments face a terrible choice. Either raise taxes dramatically, cut spending significantly, default on obligations, or inflate the currency to reduce the real value of the debt burden. History shows us which option governments typically choose. They choose inflation because it's the politically easiest path, even though it erodes the purchasing power of everyone holding that currency. This dynamic is playing out not just in the United States, but across developed economies worldwide. Europe, Japan, and most Western nations are trapped in the same fundamental problem: too much debt, too many unfunded promises, and no politically viable path to fiscal sustainability. Silver and gold respond to this environment because they represent an exit from the currency system itself. They're not someone else's liability, they can't be printed into existence, and they've preserved purchasing power through every currency crisis in recorded history. When you saw silver spike this morning, you weren't just seeing technical momentum. You were seeing the market beginning to price in the probability that currency debasement will continue and potentially accelerate. Here's where most investors make a critical mistake. They think about precious metals the wrong way. They treat silver and gold as speculative assets, things you buy hoping to sell to someone else at a higher price. But that's not what these assets fundamentally represent. Precious metals are insurance against monetary dysfunction. They're a form of savings that exist outside the banking system and beyond the reach of central bank policy. They're not about getting rich quickly, they're about preserving purchasing power over long time horizons. This distinction matters enormously for how you think about price movements. If you view silver as a speculation, then this morning's spike might make you excited about potential gains or worried about missing out. But if you understand silver as monetary insurance, then price movements are simply the market adjusting its assessment of monetary risk. Most financial professionals were trained during an era of relative monetary stability. They learned models and frameworks that assume central banks can manage the system effectively, that inflation stays contained, that debt levels don't matter as long as interest rates remain low. Those assumptions are being tested right now in real time. And many intelligent people are discovering that the frameworks they trusted are inadequate for the environment we're entering. This is why experienced precious metals investors don't get overly excited by daily price movements. They understand they are holding assets that become more relevant during the exact type of monetary stress we're now experiencing. Let's examine what history teaches us about periods like this one. Every major fiat currency experiment in recorded history has eventually failed. Not some of them. All of them. The average lifespan of a fiat currency is less than 40 years, and we're now 53 years. Past the moment when the dollar's gold backing was completely severed. This doesn't mean collapse is imminent or inevitable in any specific time frame. It means that the monetary system we're living under is historically unusual, and the stresses it's experiencing are intensifying. During the 1970s, when similar inflationary pressures emerged from excessive monetary expansion and government spending, silver increased from roughly $1.50 per ounce to over $50 in just a decade. Gold rose from $35 to over $800 during the same period. Those weren't speculative bubbles driven by irrational exuberance. They were repricing events where the market adjusted precious metals values to reflect the reality of currency debasement. Eventually, that cycle ended when interest rates were raised dramatically and inflation was brought under control through painful but necessary monetary discipline. But today's circumstances are different in one crucial way. The debt levels are exponentially higher, making the same solution politically and economically impossible. You cannot raise interest rates to 15 or 20% when your government is carrying $36 trillion in debt. The interest payments alone would consume the entire federal budget. This is what makes the current environment structurally different from past cycles. The policy options available to address inflation are severely constrained by the debt burden, creating a monetary trap that may take years or even decades to resolve. Silver and gold respond to this reality, not because traders are speculating, but because the fundamental case for holding hard assets becomes stronger when monetary authorities have fewer tools available. Beyond the long-term structural forces, several recent developments have accelerated the shift we're witnessing. Central banks worldwide have become net buyers of gold in quantities not seen in decades. These aren't retail investors or hedge funds. These are sovereign nations diversifying away from dollar reserves, a trend that signals deep concerns about currency stability. At the same time, we've seen persistent supply challenges in physical precious metals. Refineries have struggled to keep pace with demand. Premiums on physical metal over paper prices have widened, and delivery times for significant purchases have extended. This matters because it reveals a growing disconnect between paper markets and physical reality. You can trade silver contracts all day in financial markets, but at some point, people want actual metal they can hold, and that metal exists in finite quantities. Additionally, we're seeing signs of de-dollarization in international trade. Major economies are increasingly settling transactions in currencies other than dollars, reducing global demand for dollar reserves. This is a slow process, but the trend is unmistakable. Each of these developments individually might be manageable, but when they converge simultaneously with record debt levels, persistent inflation, and geopolitical instability, they create conditions where precious metals repricing becomes not just possible but probable. This morning's move in silver may be an early signal that this repricing is beginning to accelerate. We need to address something unique about silver that distinguishes it from gold: its industrial applications. Silver isn't just a monetary metal. It's also a critical industrial commodity used in solar panels, electronics, medical devices, and countless manufacturing processes. As the global push toward renewable energy accelerates, industrial silver demand is increasing substantially. This creates a situation where silver faces supply pressure from both monetary demand and industrial consumption. Unlike gold, which is primarily held for investment and jewelry, Silver gets consumed in industrial processes, permanently removing it from available supply. The silver market is relatively small compared to other commodity markets. Total annual silver production is measured in the hundreds of millions of ounces, not billions. This means even modest shifts in investment demand can create significant price impacts. When you combine increasing industrial consumption with growing monetary demand from investors seeking inflation protection, you get a supply-demand dynamic that's fundamentally bullish over the medium to long term. This morning's price action may reflect growing institutional awareness of this dynamic. As large investors begin positioning for a potential supply squeeze, even small buying can create outsized price movements in a relatively illiquid market. Let's talk about the psychological dimension of what's happening, because understanding human behavior in markets is as important as understanding economics. Most people are anchored to recent experience. If they've spent the last 15 years watching tech stocks soar while precious metals languished, they develop a mental model that says those patterns will continue indefinitely. But markets move in cycles precisely because human psychology creates extremes. When everyone believes technology stocks can only go up, that's often the moment of maximum risk. When everyone considers precious metals irrelevant, that's often when the next cycle is about to begin. We're witnessing a shift in that psychology right now. People who dismissed gold and silver for years are beginning to question whether their assumptions were correct. Financial advisors who never allocated to hard assets are receiving questions from clients who notice their purchasing power declining despite positive portfolio returns. This psychological shift happens slowly at first, then accelerates. It's not a straight line. There are false starts and setbacks. But once the trend is established, it can persist for years. The key for intelligent investors is recognizing that everyone else is experiencing the same psychological journey. When prices rise sharply, fear of missing out becomes powerful. When prices correct, fear of loss creates panic. Understanding these emotional cycles helps you avoid making poor decisions at exactly the wrong moments. This morning's spike will cause some people to buy impulsively at elevated prices. It will cause others to dismiss the entire move as temporary noise. The wise investor does neither. They observe, analyze, and make measured decisions based on risk management and long-term positioning. If you already hold physical silver, this morning probably felt vindicating. Perhaps you've been holding through years of underperformance, questioning your decision while watching other assets soar. Here's what you need to understand. Your position today is fundamentally about patience and discipline. Sharp price spikes are emotionally satisfying, but they're not the reason you hold precious metals. You hold them because they provide insurance against monetary dysfunction, portfolio diversification, and an asset that maintains purchasing power over long time horizons. This morning's move doesn't mean you should sell into strength, nor does it mean you should immediately buy more. It means you should take a breath, revisit your original thesis, and confirm that the reasons you hold the position remain valid. If you acquired silver as part of a balanced portfolio allocation, then your job is to maintain that allocation. If silver has now become an outsized portion of your holdings due to price appreciation, you might consider rebalancing. If it's still within your target range, you simply hold and continue monitoring. The worst thing you can do is make emotional decisions based on short-term price action. Sharp moves create psychological pressure to act, but experienced investors resist that pressure because they understand that volatility works in both directions. What you should do is continue educating yourself about the macroeconomic environment. Understand the forces driving your investment thesis. Stay informed about central bank policy, inflation trends, currency stability, and geopolitical developments. Your silver holdings are part of a long-term strategy. They're not a lottery ticket. They're not a get-rich-quick scheme. They're an insurance policy that becomes more relevant during monetary stress, which is precisely the environment we're entering. Maintain your discipline, ignore short-term noise, and remember that the goal isn't to time the perfect exit, but to preserve purchasing power through a period of monetary uncertainty that may persist for years. If you don't currently hold silver and you're watching this morning's move with interest, you're probably experiencing one of two emotions: concern that you've missed an opportunity, or skepticism that this represents anything meaningful. Let me address both. First, you haven't missed the opportunity. If the fundamental thesis is correct, that we're entering a period of prolonged monetary stress, then this morning's spike is likely an early move in a much longer cycle. There will be corrections, consolidations, and better entry points ahead. But second, you need to understand that adding precious metals to your portfolio isn't about chasing price momentum. It's about making a strategic allocation decision based on risk assessment and portfolio construction. The question you should ask isn't, is silver going higher from here? The question should be, do I have adequate protection against currency debasement and monetary dysfunction in my current portfolio? If your entire net worth is denominated in financial assets, stocks, bonds, real estate, cash, then you're fully exposed to the performance of the existing monetary and financial system. That may turn out fine, But it's also a concentrated bet that could prove costly if the system experiences stress. Precious metals provide diversification precisely because they perform differently than financial assets during monetary crises. They don't move in lockstep with stocks or bonds. They respond to different forces and serve different purposes. A reasonable approach for someone just beginning to consider precious metals is to allocate a small percentage of their portfolio, perhaps 5 to 10%, to physical gold and silver, not as speculation, but as insurance and diversification. This allocation should be sized so that if precious metals go to zero, it doesn't destroy your financial security. But if they perform as they historically have during monetary stress, they provide meaningful protection for your overall wealth. Timing the perfect entry is impossible. Markets move unpredictably in the short term. But building a position gradually through systematic purchases removes the emotional pressure of trying to time the market perfectly. If you decide precious metals belong in your portfolio, the right time to begin is when you've done sufficient research to understand what you're buying and why. Not because prices spiked this morning, but because you've assessed the monetary environment and concluded that protection against currency risk makes strategic sense. We should discuss what larger institutional investors are thinking right now, because their behavior often signals important shifts. Major institutional investors don't make decisions based on daily price movements. They think in terms of decades, asset allocation models, and risk-adjusted returns across various economic scenarios. For years, conventional portfolio theory has allocated 0% to precious metals, dismissing them as unproductive assets that generate no cash flow. That consensus is beginning to crack. More institutional investors are recognizing that in a world of negative real interest rates, currency debasement, and unprecedented debt levels, holding some allocation to hard assets makes sense from a risk management perspective. When institutions begin shifting even a small percentage of their massive portfolios toward precious metals, it creates sustained demand that individual investors cannot generate alone. And we're seeing early signs of this shift. This doesn't mean institutions are abandoning stocks or bonds. It means they're recognizing that the environment has changed enough to warrant diversification into assets they previously ignored. This institutional recognition matters because it suggests the precious metals market may be transitioning from a fringe position held by contrarians to a mainstream portfolio allocation held by conventional investors. That transition creates sustained buying pressure that can drive prices higher over extended periods. Let's be very clear about behaviors you must avoid, because this morning's price action will tempt people toward costly mistakes. Do not rush into leveraged positions in precious metals. Using margin, options, or futures to amplify your exposure dramatically increases risk and creates the possibility of forced liquidation during inevitable volatility. Physical metals and unleveraged positions should form the core of any precious metals allocation. Do not invest money you cannot afford to lose. Precious metals should be part of a balanced portfolio, not a speculative bet with your emergency fund or money needed for near-term expenses. These assets can be volatile in the short term, and you need staying power to benefit from the long-term thesis. Do not follow social media hype or online communities promising coordinated buying campaigns or price manipulation. These schemes inevitably end badly for late participants, and they distract from the legitimate fundamental case for holding precious metals. Do not abandon diversification. Even if you believe strongly in the precious metals thesis, concentrating your entire net worth in any single asset class is dangerous. Maintain exposure to multiple asset types to protect against scenarios where your primary thesis proves incorrect. Do not make decisions based purely on fear or greed. The morning spike will trigger emotional responses, but emotional investing consistently produces poor outcomes. Make decisions based on research, analysis, and rational risk assessment. Do not ignore tax consequences. Depending on your jurisdiction, precious metals may be taxed differently than stocks or bonds. Understand the tax implications before making significant purchases or sales. Do not assume this morning's spike guarantees continued upward movement. Markets don't move in straight lines. There will be corrections, periods of consolidation, and moments of doubt. Volatility is normal and expected. We need to have an honest conversation about something most financial media avoids, the possibility of an actual currency crisis. Not next week or next month, but as a realistic scenario that could unfold over the next several years as debt levels become unsustainable and confidence in monetary authorities deteriorates. Currency crises don't announce themselves in advance. They build slowly through years of policy mistakes, then accelerate rapidly once confidence breaks. The pattern is consistent across history: excess spending, monetary expansion, debt accumulation, inflation, then crisis. We're currently in the inflation phase. How long it persists and how severe it becomes depends on policy choices that haven't yet been made. But the trajectory is concerning enough that prudent investors are preparing for various scenarios. This doesn't mean predicting collapse or abandoning the financial system. It means acknowledging risk and positioning accordingly. It means holding assets that maintain value across different economic outcomes. Silver and gold serve this purpose because they've functioned as money for thousands of years. They've survived the collapse of countless currencies, governments, and empires. They represent a form of savings that exists independently of any government's promises or any central bank's policies. If the current monetary system continues functioning smoothly, your precious metals allocation provides diversification and inflation protection. If the system experiences serious stress, your precious metals become far more valuable as currency substitutes and stores of value. This is risk management at its most fundamental level, not fear-mongering, but acknowledging reality and preparing for multiple possible futures. One of the most important points I can make today is this: your most valuable asset isn't silver or gold or any physical commodity. It's your understanding of how the monetary system actually works. Most people live their entire lives without questioning how money is created, what backs it, why inflation occurs, or how central banking functions. They trust institutions to manage these complex systems competently and in the public interest. That trust may be well placed, but it may also be misplaced. And the consequences of being wrong are severe enough that education becomes essential. Take the time to understand monetary history, read about past currency crises, study how inflation has destroyed purchasing power throughout different eras, learn the difference between money and currency, between savings and speculation, between assets and liabilities. This knowledge serves you regardless of what happens to silver prices. It helps you make better financial decisions across all aspects of your life. It protects you from manipulation by media narratives that serve other interests. It gives you the confidence to think independently when everyone around you panics. The morning's price spike means nothing if you don't understand the context behind it. But if you understand the monetary forces at work, then you can interpret events correctly and position yourself thoughtfully. For those seriously considering precious metals as part of their portfolio, let's discuss some practical realities. Physical silver requires storage. Unlike stocks or bonds that exist as electronic entries, physical metal needs to be kept somewhere safe. This might be a home safe, a bank safety deposit box, or a professional storage facility. Each option involves costs and considerations. You'll pay premiums over spot price when purchasing physical metal. Dealers, mints, and refineries charge for production, distribution, and their services. These premiums vary based on product type, quantity, and market conditions. Factor these costs into your return expectations. Liquidity varies significantly. While silver is globally traded and generally liquid, selling physical metal quickly at fair prices requires planning. You can't liquidate physical silver with a phone app the way you can sell stocks. Build relationships with reputable dealers before you need to sell. Authentication matters. As precious metals become more valuable, counterfeits become more sophisticated. Purchase from established, reputable sources, and consider verification services for significant holdings. Consider different forms of ownership. Physical metal you hold yourself provides maximum security and privacy. ETFs and mining stocks provide paper exposure without storage concerns, but introduce counterparty risk. Each approach has trade-offs. These practical considerations aren't meant to discourage you. They're meant to ensure you approach precious metals investing with realistic expectations about the process, costs, and responsibilities involved. Step back from this morning's price action for a moment and consider the broader trajectory we're on. The global financial system is undergoing its most significant stress test since the 2008 crisis. Central banks have deployed unprecedented stimulus. Governments have accumulated unsustainable debts. Inflation has returned after decades of absence. Currency wars and geopolitical tensions are intensifying. These aren't temporary disruptions. They're structural challenges that will define the economic landscape for years or potentially decades to come. Within this context, precious metals aren't speculative bets or fringe assets. They're logical portfolio components that address specific risks inherent in the current environment. You don't need silver to go to $100 or gold to go to $5,000 for these assets to serve their purpose. You need them to maintain purchasing power, while paper assets potentially struggle during monetary instability. This morning's spike might mark the beginning of a significant repricing, or it might prove to be a false start followed by consolidation. But the underlying fundamentals that make precious metals relevant aren't dependent on short-term price action. They're dependent on whether governments continue expanding debt, whether central banks continue expanding money supply, whether inflation persists, and whether confidence in currency stability remains intact. Current evidence suggests all these trends are not only continuing, but potentially accelerating. That's the bigger picture that matters far more than any single morning's trading. The most successful precious metals investors I've observed over decades share common characteristics that have nothing to do with timing or luck. They make decisions based on analysis rather than emotion. They maintain positions through volatility without panic selling. They ignore short-term noise and focus on long-term fundamentals. They understand that preserving wealth during uncertain times matters more than maximizing returns during bull markets. This discipline is difficult to maintain. When everyone around you is making money in technology stocks or cryptocurrencies or real estate, holding silver feels frustrating. You question your judgment. You wonder if you're missing opportunities. But then environments change. The assets that worked brilliantly for years suddenly struggle, and the assets that seemed boring or outdated prove their worth by maintaining value when everything else falters. Discipline means continuing to do the right thing even when it's uncomfortable. It means maintaining your portfolio allocation even when precious metals underperform. It means not chasing performance into overvalued assets. It means accepting that protection costs money during good times, but pays dividends during bad times. If you approach precious metals with this mindset, then this morning's spike is neither cause for celebration nor concern. It's simply one data point in a long-term journey. The real measure of success isn't daily portfolio value. It's whether you've positioned yourself to weather multiple economic scenarios and preserve purchasing power over decades. So where does this leave us? What should you actually do with this information? First, assess your current situation honestly. Do you have adequate diversification? Are you overly concentrated in financial assets that depend on continued monetary stability? Have you given serious thought to currency risk and inflation protection? Second, educate yourself further. This video provides context, but it's just a starting point. Read books on monetary history, study past inflationary periods, understand the mechanics of central banking and government debt. The more you learn, the better your decisions will be. Third, if you decide precious metals belong in your portfolio, create a systematic plan. Don't chase prices or try to time perfect entries. Build positions gradually over time through regular purchases. This removes emotional decision-making and ensures you're not overcommitted at any single price point. Fourth, maintain perspective. Precious metals are one component of a comprehensive financial strategy that should include emergency savings, debt management, income diversification, and investments across multiple asset classes. They're important, but not sufficient by themselves. Fifth, stay disciplined through volatility. There will be days like today when prices spike and you feel vindicated. There will be other days when prices fall and you question everything. Your job is to maintain conviction in your thesis while remaining flexible enough to adjust if fundamentals actually change. Sixth, ignore noise. Financial media will tell countless stories about why prices move today. Most of these narratives are constructed after the fact and provide no useful information for decision-making. Focus on understanding underlying forces rather than explaining daily fluctuations. This morning's movement in silver prices represents something more significant than a typical market fluctuation. It's a signal that the monetary environment is shifting in ways that make hard assets increasingly relevant. Whether this proves to be the beginning of a major repricing or simply a notable day in a longer consolidation period, the underlying fundamentals that make precious metals valuable haven't changed. If anything, they've strengthened. You live in an unprecedented era of monetary experimentation. The consequences of creating trillions in new currency units while accumulating unsustainable debts are now becoming visible in ways that affect your daily life and financial security. Precious metals offer one of the few proven hedges against these forces, not because they're magic, but because they've functioned as stores of value throughout thousands of years of human history, surviving the collapse of countless monetary systems. Your task isn't to predict what silver will do tomorrow or next month. Your task is to understand the environment you're operating in, assess the risks you face, and position yourself thoughtfully to preserve wealth regardless of which scenario unfolds. This requires education, discipline, patience, and emotional control. It requires thinking independently rather than following crowds. It requires making decisions based on probability and risk management rather than certainty and guaranteed outcomes. The morning's price action will fade into history, but the underlying monetary dynamics driving that action will persist and likely intensify. How you respond to these dynamics will significantly impact your financial security over the coming years. Stay informed, stay disciplined, stay focused on fundamentals rather than noise, and remember that the goal isn't to get rich quickly, but to preserve purchasing power and protect your financial future during a period of extraordinary monetary uncertainty. That's the real story behind what happened at 11 o'clock this morning. Not a price spike to get excited about, but a signal worth understanding deeply. Thank you for taking the time to think through these important issues carefully. Your willingness to engage with complex topics and question conventional wisdom will serve you well in the challenging times ahead.